Hello friends, this is Manoj Goyal from the Wall Street School. We have been training students in the field of investment banking for over 10 years now. Friends, we are getting a lot of requests for making videos on the most frequently asked questions in the investment banking interview. Hence, we have analyzed thousands of questions which were being asked from our students over the past few years in their interviews. Friends, we have already made 2 videos on the same, where we have covered such questions along with brief suggested answers in a structured way. Now, this third video is in continuation of the same. So let's get started.
Hello everyone, welcome back. I hope all of you are fit, fine and safe and are doing amazingly well. 1 year ago, I uploaded this video, Investment Banking Interview Questions with Detailed Answers, and this video got phenomenal response. Therefore, 4 months back, I uploaded second video in the series, Investment Banking Interview Questions with Detailed Answers Part 2, and this video also got good response. So this video is going to be the third video in this series, Investment Banking Interview Questions. In this video, we are going to discuss about questions related to merger models. Right? In a typical investment banking interview, you will be asked technical questions, you will be asked some analytical questions, some situational questions, and some personal questions. In this video, we are going to talk about accounting part, modeling part, and valuations part related to merger model. Right? So let us start. Let us start with the very basic question. What is the flow of a typical M&A deal? So a typical M&A deal can be divided into 3 phases: a pre-merger phase, merger negotiation phase, and a post-merger phase. So in pre-merger phase, first of all, you have to get signed as an investment banker of the client. So you'll pitch the client some idea of buying some company, selling his company. Once you are signed as an investment banker of the client, you start with your own due diligence so that you can be sure of the material that you are going to market. Then you start with the valuations and you start preparing marketing material. Then marketing material like teasers, pitchbook, etc. And once this marketing material is ready, you will reach potential clients. After reaching this potential client, the first step is over. That is pre-merger phase. Then starts the merger negotiation phase. In merger negotiation phase, the clients that you have reached, if they are interested, will sign something called as NDA, non-disclosure agreement. That is, they are not going to disclose the information that is going to be shared with them from now onwards. Then the clients will start receiving the information related to clients and will start doing their due diligence, preliminary due diligence basically. And after preliminary due diligence, if they are interested in the deal, they will give something called as letter of interest. That is just telling the opposite party, we are interested in knowing more about the company. We want to close the deal, but still not very much sure about it, but at least we have some initial interest. Then digital data rooms are created where extensive information is shared with the clients about the company, their contracts, their banking statements, and other details with the client, with the parties who have submitted letter of interest. And after that, the clients who are really interested in the deal will share something called as letter of intent. That is, we are really willing to close the deal. Let us start negotiating on the final part. After that, the buyers and prospective sellers will meet. The deal will be structured, a final offer will be made, and a definitive agreement will be signed, also known as purchase agreement or merger agreement. So merger negotiation phase starts with signing NDA and ends at creating a definitive agreement. Once this definitive agreement is signed, the deal is announced in the market, legal formalities are done, the payouts are done, and 2 companies are integrated. So this is how a typical M&A deal looks like. Obviously, there will be some variations on deal-to-deal basis, but this is what you should broadly expect. Now let's move towards the next question. That is, what is a teaser? Okay, so teaser is a very small, like 3-4 pager marketing document prepared by investment bank to reach out potential clients and get their initial interest. So investment bank will prepare this small marketing document. You can consider it as a brochure of a product. Within 3, 4, 5 pages, all the highlights of the product is displayed in the brochure. Similarly, in teaser, all the highlights of the company, the industry, its unique selling points, whether it is a market leader, high margin, superior product, very good growth rate, all these technological breakthrough, all these details are given. That is, fine points about the company is given. Name of the company is not mentioned in teaser because you want to keep it secret until unless the client have signed non-disclosure agreement. Some financial highlights will be given. So last 3 years sales, projected sales, EBIT margins, EBITDA margins, net profit. Then some investment highlights could also be given, whether you are looking for like LBO or whether you are looking for complete M&A, why the client is selling, whether he will be with you or not post the deal is done. So basically all the details about the company and industry in which it is operating without disclosing its name, right? And this teaser is considered as a confidential document. That is, you are not expected to share this teaser with someone else. The client who have received the teaser is not expected to share this document with others, right? And this is a non-binding document. That is, this is not legally enforceable documents. It's just a brochure, right? Now let us move ahead and talk about what is a pitch book and what are its types. Pitch book is a very extensive marketing material. Like I said, teaser is a 3-4 page document and I compared it with a brochure. Pitch book will be 100 plus pager document and I can compare with manual. So in pitch book, your company profile, market overview, industry overview, positioning into the industry, valuation summaries, football field analysis, potential buyers, targets, rationale for merger, reason behind a particular merger, all the things are given in very extensive detail. This is basically all the things that you would want to know as a potential investor summarized into few hundred pages, right? In general, pitch books are of two types: the bank's pitch book and the deal's pitch book. The bank's pitch book is investment bank preparing a pitch book in which it is highlighting its specialization, its expertise, the team which it is having. So when investment banker wants to get signed by someone else, it have to market itself. So it will tell about the deal in that particular industry they have done, the amount of fund raised, specialization of management team, how much experience the management team is having. And then this deal pitch book, it really depends upon what kind of deal you are working with. So it could be say IPO pitch book, it could be say pitch book for raising other form of capital, it could be a sell side pitch book, it could be a buy side pitch book, right? So these are two broad types of pitch books. Now let us move ahead and talk about what is indication of interest. So indication of interest is first of all a non-binding document shared by the interested party to the investment bank to inform that they are really interested in closing out the transaction. It will just act as a base for final purchase agreement. So it will contain details about the approximate price range. It could be a dollar value range or it could be expressed in terms of multiples. Availability of funds, that how the deal is going to be financed. Rough timeline to complete the deal and time required to complete the due diligence process. Then proposed transaction, whether it will be stock deal or asset deal. Then management retention plan, whether the current management of the company that is being sold or purchased will be retained in future or not post the transaction, and other general conditions for closing the deal. Okay, like the flow is, once you share the marketing documents, you will sign NDA and you'll start sharing pitch books and other details. And after sharing pitch book and other details, if the party is interested in closing the deal, they will give you indication of interest. Okay, now let us move ahead and talk about another document that is bit more formal in nature than indication of interest, called as letter of intent. Okay, letter of intent. So what happens is, the flow is, after sharing letter of interest by the interested parties, they want to do extensive due diligence. That is, they need information that is very private to the seller, the target company. So a VDR will be created. VDR is virtual data room, in which all the confidential documents related to the target company are uploaded, like its banking statements, its audited accounts, the contracts which it is currently having, the purchase orders, maybe the guarantees given by this company, the tax matters that are currently disputed, and patents, and all the details are uploaded on this VDR. The details available at this VDR, virtual data room, will be used by these interested parties to complete their due diligence. And in the meanwhile, if they are really interested in closing out the transaction, they will share something called as letter of intent, LOI. right? So letter of intent is much more formal document than letter of interest. It is non-binding in nature, but still bit more formal. It is like you are moving towards completion of the deal. So it will contain terms like the structure of the deal, whether it is going to be a stock deal or an asset deal, or 338H10 will be elected, or the compensation part, whether it will be cash deal, equity deal, what about rollover equity, what about earnouts, what about seller notes. Then it will contain detail like the closing conditions, like what conditions should be satisfied to close out the transaction, and broadly at what date you are looking forward to close out this transaction. Then no shop, go shop, that is for some period, next 60 days, next 30 days, the seller is not going to look for any other buyer who is ready to pay more, right? Exclusivity is granted to the person who is sharing this letter of intent. It's like roka in our Indian tradition. So once the roka is done, you stop looking for potential mates. The same thing is, once this letter of intent is submitted and no shop go shop is executed, that is, you are not going to go to some other person to sell your company for some period. Then breakup fees, that is after merger agreement is signed, if something goes wrong, one party say no to the merger, this defaulting party will pay the non-defaulting party some amount for wasting its time, energy and the resources. Then management compensation, that is what will happen to current management post the completion of transactions, and what about their like retainership. Then due diligence, in how many months or in how many days you are expected to complete the entire due diligence. Preliminary is already done, the detailed due diligence is going on, so broadly at what point in time it will be done. Then confidentiality, that is whatever was written in non-disclosure agreement is still binding. Then you have approvals required, so if in case you need approval to close out the transactions, maybe competition commission approval, approval of board of directors, shareholders, or any statutory approvals, these are to be written. Then escrow is whatever consideration is to be paid, say 90% of the consideration will be paid in one go and 10% of the consideration will be held back, so that if in case in future till certain period some liability emerges from the past, this 10% could be used to pay off those liabilities, because the seller did those transactions and it should be seller's liability to disclose it. But if in case something is not disclosed or any unknown liability from the past emerges before the transaction is closed, then this 10% can be used of the purchase consideration to settle those liabilities. And if nothing emerges, this 10% is transferred to the seller. So this 10% is kept in a separate account called as escrow. And then you have something called as reps and warranties. Reps and warranties is basically the seller is saying whatever we are disclosing you is true and correct, and if something goes wrong, you have a warranty from our side that we will make it correct, right? It is kind of an indemnification clause like you see in your insurance contracts, right? So this is letter of intent. Once this letter of intent is submitted, this exclusivity is granted. Then assuming everything goes well, that is, there is no problem identified in full-fledged due diligence, the detailed due diligence, the buyers and the sellers will meet each other, will finalize the terms of contract, the terms of M&A, will finalize the compensation, and the transaction will be closed. And whatever are the finalized terms, they are written in a document called as purchase agreement, also known as merger agreement, also known as definitive agreement. Same document, different names. So what is a purchase agreement? Purchase agreement, okay. So this is the final document in the merger negotiation phase. Post this, post-merger phase will start. So this document contains all the finalized terms of a merger. It is found as a part of 8K report. So in whichever quarter the transaction is announced, in the respective quarter's 8K report, this purchase agreement is attached, right? This document is finalized. So if in case post-merger there is any issue, any dispute, this document will be referred. Letter of interest, letter of intent, or teaser or any other document is not legally enforceable, right? Whatever is written in this document is final. It is not prepared by you as investment bankers. The lawyers who are working on this deal will prepare this purchase agreement in their typical legal language, right? This takes us to the next question, important clauses of a purchase agreement. So it will contain whatever was written in your letter of intent in much more elaborated form. So broadly the heading remains the same, but it will be much more detailed and precise in nature. So who exactly is the buyer and seller, price per share in case of public companies and lump sum price in case of private companies, effective closing date, type of transaction 330-10 or stock based or asset based, then treatment of outstanding shares, what will happen to ESOP, what will happen to SAR, what will happen to RSUs and other dilutive securities, reps and warranties section will be there, then no shop go shop section will be there, financing, termination fees, indemnification, material adverse changes and material adverse effects clause, and closing conditions. So basically it is letter of intent in a very glorified way, right? Now this ends the theoretical part. Now we'll be moving towards the financial modeling part of merger model, right? So what exactly is a merger model? Let's discuss this. Okay, so a merger model is a kind of a financial model in which you combine the financial statements of buyer and seller and create a financial statement of a combined company and project it. The purpose of creation this combined company's financial statement is if in case the buyers acquire the seller company, this deal is executed in real life, whether this deal will be beneficial for the buyer as well as the seller, right? So before the deal is done on papers, you are executing it on Excel sheet so that you can analyze whether this deal will be accretive or dilutive and what will be the impact of this deal on revenues and cost, and whether this deal will generate wealth for the investors or not, right? This is merger model in very simplest form. Now what are the steps to create a merger model? Okay, so the steps to prepare merger model, in total I can divide it into 10 sub steps. The first step is to project or forecast financial statements of the buyer on stand-alone basis. So next 3 years, next 5 years of buyer, assuming there is no merger. Then financial statements of seller will be projected for next 3 to 5 years, assuming there is no merger. Then you estimate purchase price, that is at what valuation buyer will be buying seller, and then you estimate form of payment. That is how the seller will be paid by the buyer. Then you prepare the opening balance sheet of combined company. That is, once this deal is executed, at that point in time, how will the combined company look like? The opening balance sheet of combined company, right? After getting this opening balance sheet of combined company, you start preparing synergy schedule. That is, you project the synergies of the combined company, and once this synergy is done, you incorporate this synergy into income statement. And if in case to complete income statement, if any supporting schedule is required, like fixed asset schedule, like debt schedule, to prepare this. So synergy and income statement and supporting schedule. Once this income statement is done, you move towards cash flow completion. You prepare cash flow statement, and using supporting schedules, income statement and cash flow, you can project next 4-5 years balance sheet. So you have now balance sheet, you have income statement, and you have cash flow statement of the combined entity. Now this is time for analysis. So for analysis, you prepare key metric schedule. After completion of key metrics, that is the ratios, how it is impacted because of merger, growth in revenue because of merger, suppression of cost or growth of cost because of merger, all these things will be taken care into account. Then you will create accretion and dilution schedule, that is impact of this merger on EPS, and in the end you will prepare sensitivity tables. So you will be stress testing this M&A, that is this merger model, on the basis of some sensitivities. Sensitivity will be generally around synergies, will be generally around the purchase price, right? So this is broadly how you prepare merger model. Now let us move ahead and talk about transaction structure that you could use to acquire another company. So if merger is happening, it could be a stock deal, it could be an asset purchase, or it could be 338H10 selection. What is this 338H10? We'll discuss in some time. So broadly, there are three structures of the transactions, a merger transaction: stock, asset, or 338H10. Okay. Now let us move ahead and talk about what is stock purchase and which party will prefer it. So stock purchase means, see, let me give you an example. There is A company and there is B company. A wants to acquire B company. So B is the seller, A is the buyer. So one way to acquire B company is to acquire shares of B company. Or another way to acquire B company is to acquire all assets and liabilities of B company, right? So if in case shares of B company is acquired by A company, it is called as stock purchase. Now, what are the advantages or the special characteristics of the stock purchase? The first one is, if there is stock purchase happening, that is the shareholders are just changing, B as an entity will stay there. So what will happen? All assets / liabilities and off balance sheet item will get transferred, right? Because only shareholders are changing. So whatever were the liabilities of B shareholder will become the liabilities of A shareholder. Number two, there will be no step up of assets that are being transferred, and that in turn will create deferred tax liabilities. What is deferred tax liability and how it gets created in this M&A transaction, we'll discuss in some time. But there is no step up of asset base for tax purpose. That is, the assets of this company are in place. What is happening? The shareholders are exchanging, right, the shares. So what is happening? Because of this, the asset base of the company, whatever value was recorded in the books of accounts, remains the same. And because of this, deferred tax liabilities gets created. Number three will be, the seller will get to pay capital gain tax. So what is happening? Shareholders of B are selling their shares. On sale of shares, you charge capital gain tax. So in general, sellers will always prefer the stock purchase. The reason is, first of all, generally capital gain tax is lower in comparison to your business and profession tax. Other than that, all the liabilities along with off-balance sheet items gets transferred to the new owner. So if in case there is some dispute that is emerging from the past activities, now this person will be responsible to take care of those disputes. These sellers are not going to bear the consequences of the disputes that emerges in future post this deal have happened, right? So sellers, which party prefer? Seller will prefer stock purchase. When I was not able to understand the logics behind it, I always used to think S for stock purchase and S for seller. So preference will be seller's preference to go for stock purchase. Now let us move ahead and talk about asset purchase and which party will prefer it. So this is a negotiation happening. So which party will prefer? Buyers will prefer asset purchase, and there is the reason for it. Let us understand what is an asset purchase. A company wants to buy B company. So one way was to purchase shares of B, and second way is to buy assets and liabilities of B, right? So in this case, if I am buying assets and liabilities of B, first of all, there will be step up of asset base. That is, whatever are the book values, they will be brought to fair market values, and using this step up, I can claim more depreciation in my books of accounts in the upcoming years. So DTL is not created, number one. Number two, All the assets and liabilities need not to transfer. So selective assets, whatever the buyer wants to pay for, will only pay for that. So not all assets and liabilities are transferred, and buyer will prefer it. He can be selective and pay for whatever he wants to pay, right? Seller is taxed twice. Sir, how twice? Firstly, when the assets are being sold, so the company will be taxed. Once this company pays off to the shareholder the special dividend, or whenever the profits on sale of these assets are withdrawn from the company, then there will be dividend distribution tax or some other kind of special tax. So the sellers are taxed twice, right? So this is asset purchase. It is preferred by buyer because they don't take away the liabilities. They can be selective of the assets they want to take, and like buyers can step up their asset base so that they can pay less taxes in future. Okay. Now the next question is, what is 338H10 election? So okay. So firstly you will be asking, sir, what is this 338H10? So 338H10 is a section of IRS. IRS is income tax of USA. A section of it is called as 338H10. This section allows S Corp firm to treat stock deal as asset deal for tax purpose. Okay. So now the question arises, sir, what is this S Corp? So S Corp is a firm, is a business in which less than 100 shareholders are there, and this enables the company to be taxed as a partnership. So though it is a company, but it is taxed as a partnership. So they don't typically pay taxes. Instead, they just file some kind of informational return. To be precise, form 1120S, but we don't need to get into this detail, right? Basically, it is allowed to smaller firms with less than 100 shareholders to treat stock deal as an asset deal for tax purpose. We just learned few minutes back, a buyer will prefer asset deal and the seller will prefer stock deal. Why buyer is preferring asset deal? Because of this asset deal, he is allowed to increase the book value of asset to fair market values. That is, step up of asset base is allowed. So when this step up of asset base is allowed, that is, the assets have increased in value, this will lead to more depreciation in future, and more depreciation in future will lead to lower profits before tax, and lower profit before tax will lead to low taxation in future. So since the seller will pay less taxes in future, he wants to go for an asset deal. The buyer will prefer to have a stock deal. The seller will prefer stock deal. Why he will prefer stock deal? Because all his assets along with the liabilities and off balance sheet items will be transferred to the purchaser, right? So now seller is no more responsible for anything that happens post the transfer of shares, right? So seller wants stock deal, buyer wants an asset deal, and 338H10 is best of both worlds. So in real, you can execute a stock deal, that is, seller will become happy because he'll be able to transfer all his liabilities and off balance sheet items, and the buyer will also be happy because he'll be able to step up the asset base and in future pay less taxes. So 338H10 is basically best of both worlds. Think about it, whether DTL will be created in 338H10 or not. And the answer is no, because the asset have already increased in the values. Therefore, this is happening in books of accounts, and along with this is happening in your tax books also. So if in both the books the depreciation amount is same, no DTL will be created, right? So 338H10 is best of both worlds. Okay, now let us move ahead and talk about how do you account for transaction cost, financing fees and other expenses in a merger model. Transaction cost, like your legal fees and advisory fees, this is written off. So transaction cost is written off immediately from reserves and surplus, that is your retained earnings, and your financing fees is amortized and written off over life of debt. Okay, so this will be appearing on balance sheet asset side as capitalized financing fees, and this will be just written off from your reserves and surplus. Okay, with that being said, we are stopping for this part of merger model interview questions with detailed answers, though many more questions are pending, but this video is approximately 30 minutes of recording right now. So not to make it very cumbersome to watch in one go, I'm dividing this part into multiple parts. So the next part of merger model interview questions will be uploaded in some time. Till next time, thank you for watching this video. And if in case you have any queries or comments, feel free to reach us at thewallstreetschool.com or in the comment section below. Thank you.